This is the Rich Dad Radio Show. The good news and bad news about money. Here's Robert Kiyosaki.
Hello, Robert Kiyosaki, the Rich Dad Radio Show. And it is the good news and bad news about taxes. And this is a 4-part series. For all you people who love paying taxes, you can check out now. But if you hate paying taxes, this 4-part series is just for you. Because as I think some of you suspect, or as former President Trump admitted in front of Hillary Clinton, I think in 2016, she says, well, you don't even pay taxes. And Trump says, that's because I'm smart. So if you want to be like Trump, stay tuned for this 4-part series. You want to be Hillary, you can leave now. Because I don't know what she's up to, but she makes money the old-fashioned way. I won't say it, but they make it differently than Trump does, because it's not taxed, it's how you earn your money. Again, it's a 4-part series. We're going to have one on entities, which are corporations, and how the rich use corporations to shield their money from taxes and from predators like lawsuits. Today's issue is about paper assets, stocks, bonds, mutual funds, and ETFs, and how the tax advantages play inside paper assets. We're going to do one on real estate with Kenny and Tom Wheelwright. Why Trump, Kim, and I don't pay taxes? Because we're real estate guys. I mean, there's a reason for being in real estate, is because it's the biggest tax break you could ever get. And then the other one is going to be, the 4th one is on gold, silver, and Bitcoin. And what are the tax advantages of gold, silver, and Bitcoin? And how do you avoid paying taxes and still making millions of dollars? So today's program, what do you want to say? Excuse me.
No, you're doing just fine.
I get so excited about taxes. I get so excited about taxes.
You're more excited than Tom Wheelwright. Oh my goodness. No, this is a great series, because taxes, you talk about misinformation. People have so much misinformation about taxes, and they all say, oh, the rich should pay more in taxes and the poor should pay less in taxes, and it has nothing to do with that. I mean, it's when you say, Robert, that, Trump says I'm smart, it's because he's using the tax laws to his advantage. And there's the reason tax laws are, and Tom's going to talk about this, they're just incentives to do what the government doesn't want to do. That's what it is. We're doing what the government doesn't want to do that needs to be done. It's very simple. So I'm glad we're doing this series. And I think there's a lot of good information that people need to hear about.
And it's a 4-part series because the people that cheat most of the taxes aren't the rich.
No.
They don't have to.
We don't cheat.
But the people that cheat are small business owners and employees, because they got no escape.
Pay me cash under the table. Pay me cash under the table.
Cash on the table, and all this.
All of that.
They're the biggest tax cheats going around. So you don't have to be one if you're rich.
You don't have to be one if you're not rich. You don't have to be a cheat at all when you're paying taxes.
Unless you're like Obama, Biden, and Clinton. They make money the old-fashioned way, called political favors. I don't know what kind of tax that's called, but it's a tax on all of us, one way or the other. So Tom, I guess Tom is our resident expert on taxes. So Tom, a quick CV on what gives you the right to know more about taxes, and Kim and I.
And Tom Wheelwright is author of Tax-Free Wealth. Go ahead, Tom.
So thank you, Robert and Kim. So first of all, I have my undergraduate degree in accounting from the University of Utah. Go Utes, Andy. I have my graduate degree in accounting, specializing in tax, from the University of Texas in Austin. I spent 7 years with Ernst & Young, one of the largest accounting firms in the world, including 3 years in their national tax department in Washington, D.C. I spent 14 years as an adjunct professor in the Masters of Tax program at ASU, 25 years building, buying, selling CPA firms, and the last 15 years traveling the world with you guys and everybody on this show, talking about taxes in every country. So that's the cool thing, is that the tax law, as Kim, you say, is a series of incentives. It's not just a series of incentives in the US, it's a series of incentives in every country.
Could I just show quickly, because this is my new flip chart here. This is the cash flow quadrant, book number 2 in the Rich Dad series. You have E, employee, S is small business, B is big business, and I is professional inside investor. Okay, an insider invests from the inside, everybody invests from the outside. So E's all over the world pay about 40%. The S's, the small entrepreneur, pays about 60%. Big business pays about 20%. And the insider pays 0. And every place Tom and I went throughout the world, some idiot would argue with us, right, Tom? They'd actually argue with you.
There was every time somebody come and say, this is great information, it doesn't work here, right? It only works where you are. It doesn't work where we are.
And they say that in the U.S. Well, you can do that in Arizona, but you can't do it in
Texas. It doesn't matter. It doesn't matter where we are. And now if you're in Moscow, in Moscow, of course, they say, well, we pay whatever we want to pay because the law's just the suggestion there. Here we actually, feel obligated to pay the taxes. And like you say, it's really not whether you're rich or poor. It's really how much you understand about the tax law.
Right. And then E's and S's are the biggest tax cheats going.
Well, and really, Robert, it's just because of a lack of education. So the E's are stuck. I mean, there's, unless they go to S or I or B, they're stuck. But the S, they can get the same tax rate as the B's. They just have to follow the rules of the B's.
Yeah. And the reason they're a tax cheat, they say we accept cash.
Exactly. The moment, or even better, it's a 20% discount if you pay cash, right? Right? Because they're escaping 40% tax, and they're happy to give you a 20% discount.
It is so funny. And then a lot of these guys, they want it under the table.
Yep. Don't send me a 1099. Don't send me a 1099.
Yeah.
Sorry.
But they go to church, are good Christians, but they'll cheat the effing government. This last guy Kim and I had a run in with. We gave him a couple of things, and then he got upset because he had to pay tax on it. I'm like, but we obey the law. He says, but I'm a good Christian. I said, yeah, but we obey the law. Anyway,
okay, moving on.
It's a psychotic subject. Anyway, with that, Andy, give us an introduction.
Andy Tanner. Randy Tanner's a Rich Dad advisor. He's the author of 401 Chaos and Stock Market Cash Flow. And one of the things I learned from Andy early on is that you can actually get cash flow out of the stock market. I never knew that. Didn't know, Andy. You're welcome.
Oh, thanks so much, guys. I'm only qualified to be here because Tom is my accountant. I live vicariously through him. And had I gone to school with Tom, I probably would have been one of those cheats looking on his papers. But this will be an exciting thing because a 401k plan is a tax to be poor when you're old. It's a plan to be poor because a couple things are going to happen. Number one, you're going to take investor risk but pay employee taxes. That's very important. Because these guys that are investors are going to pay a lower rate of tax than an employee because they're willing to take more risk as an investor. So they're going to take investor risk and pay employee taxes because that money's taxed as employees, then it's invested, and then when they pull it back out, they have to pay taxes. And then the second thing I'll say, it's a plan to be poor because the lure or the attractiveness of it is, well, when you're old, you'll be poor and you'll be in a lower tax bracket. And so if you plan to be poor, the 401k is for you.
That's definitely not our philosophy.
I'm excited for the discussion, and I'll leave the advantages of a Roth in the United States to a 401k to Tom to talk about.
But Andy, somebody could actually lose money on their 401k and still have to pay taxes on it, right?
Yeah,
like as a gain.
Yeah, I'll leave that. I just worry about what company is best, and I say, Tom, fix the tax problem, please. So we'll leave that one to Tom. But it's great to be here, so thank you.
Thanks, Andy.
And now is a really good friend of Rich Dad is a fellow Hawaiian from Hawaii, a neighbor in Hawaii. John comes from the dark side because he and Nancy Pelosi are best friends. They're liberal. I'm only kidding. But one of the reasons I say he comes from the dark side is we played rugby together, and then I found out he's a financial planner, and I couldn't talk to him anymore. But he's come back from the dead, from the dark side. He now understands that he's going to share how his way of making money is not what the financial planners say. So John is the best because I listen to all these financial planner shows, pitch, I won't mention their names. I just call John and say, yes, we do it differently. We don't make money unless the client makes money because we're fiduciary. And I called John up and I said, what do you think about that? He says, it's bullshit. They're lying to you. Because the reason John understands the dark side is that's where he came from. And that's why he moved out of it. So what's the name of your book there, John?
Thanks, Robert and Kim. It's great to be on the show again. It's the top 10 reasons the rich go broke.
Because they listen to financial planners.
and what I love about your book, John, is not for rich people necessarily. It's the lessons that people, why they went broke and why you don't have to go broke no matter how much money you have.
Yeah, exactly, Kim. I mean, I've learned through you guys, learning from people's successes is smart, but learning from people's mistakes is genius. And I think that's where people go wrong and they don't learn from their mistakes. And that's what the book is all about. It's 10 stories of people that I knew that had everything and then lost it all. And to your point, one of the key stories is I trusted my financial advisor. That didn't go well. That story did not end well. But
and wait, and the sad thing is, this financial advisor is a stud in Hawaii. I mean, he's smart.
He was until he hung himself.
Wow.
Literally, he hung himself when he got caught. So yeah, it's a tragic story, and people just put all their faith in this advisor without any due diligence, any questions whatsoever, and it was just a horrible situation for the clients.
I learned that lesson very early on, years and years and years ago, when Robert and I were just starting out, and there was a stockbroker, and he said, "Oh, you got to buy Coca-Cola. Got to buy Coca-Cola." And we're like, "Okay, we'll buy Coca-Cola." We didn't know much about stocks at all. And then I just had a gut feel that it's time to get out. And so I called him up. I said, "We want to sell. Let's sell." "No, don't sell. Don't sell." I'm like, "Yeah, we want to sell.
Buy
it looks good." "Yeah, no, hold. It's going to go higher. It's going to go higher." Well, of course it didn't. And we lost money. And that I trusted his advice instead of trusting myself. More importantly than trusting myself, doing my homework and doing getting educated.
So John, when this one they advertise every night on Fox. And they say, we're a fiduciary. We don't make money unless our clients do. Are they lying or telling the truth?
Well, it's a very hazy message. It's very opaque in how they're describing that. Bottom line, it's total BS. There is...
It's not surprising to me that you would be very familiar with the words haze and opaque, John.
We'll get into the 401k discussion in a minute. I got a new title for your second book. It's called "Sorry, I Was Wrong." Anyway, this idea that they do things differently, and we're fiduciaries, therefore we're holier than now, couldn't be more dangerous information sharing to the client. I mean, this whole fiduciary thing is an absolute myth, and it's misleading people to commit all their hard-earned money with somebody just because they're a fiduciary.
What does that mean, a fiduciary?
It means that the financial advisor is held to a higher standard. They're working in their client's best interest versus a non-fiduciary who's working who's offering advice that's suitable. Now, certainly best interest sounds much better than suitable, but when you boil it down, all you're really talking about is your ability to sue the advisor versus not. I could tell you, I could make a very strong argument that you are in much better and safer hands with a non-fiduciary than you are a fiduciary. Oh. And I'm not saying one is bad or the other. It really depends on the advisor, but there is far more oversight and regulatory compliance with a non-fiduciary than there is a fiduciary. Anyone could open up an investment advisory firm and be a fiduciary. I mean, it's really that easy. And just to sum it up, Bernie Madoff, the biggest scandal in, I think, the history of the world, was a fiduciary. So this term fiduciary is it's a marketing pitch by a lot of advisors, really.
So Tom, as an accountant, as a CPA and all this, let's go quick. If somebody is an employee, can you help them very much?
Not very much, a little bit. And we can actually in this area, and we'll talk about that, but not a whole lot.
But this person here doesn't have to be a tax chief, do they?
Correct. I mean, that person could easily be paying taxes at the rate of the B or the I with just a little bit of tax advice.
And if an employee started a part-time business, does that give them tax advantages?
Oh my heavens. I mean, just consider during the pandemic, everybody's been working from home. And the question I always get is, well, I'm working from home, so I get to deduct my home office, right? Not if you're an employee, only if you have a business. So if you have that side hustle, you can deduct that home office. But if you're just an employee, you get nothing.
Before we go to break, Tom, we want to be very clear on this. You know, people say get a 401k. That's the appropriate vehicle for most people if they have no financial education. Would you agree with that?
No, I agree. And there are cases, and we'll talk about this after the break, where a 401k, a certain type of 401k actually makes sense for stock investing from a tax standpoint. So we'll talk about that when we come back.
Okay. So
wait a minute. Did I hear that correctly? That's going. That video clip's going on my website.
Just don't edit that down, John. Make sure it's a certain type for certain people, as opposed to period.
I didn't hear that part.
So we come back from going more into the most important subject of your life. It's called taxes, and as we all know, it's going to go up because Biden is in charge. We'll be right back on how you can make more money and pay less taxes. We'll be right back. Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about taxes. Remember, this is a 4-part series. One is about taxes and entities. Another one is taxes and real estate. Another one is taxes and paper assets. And the fourth one will be on taxes, gold, silver, and Bitcoin. Because if you love paying taxes, you can check out now. But if you want to make more money and pay less taxes, this 4-part program is just for you. You can listen to the Rich Dad Radio program anytime, anywhere on iTunes, Android, or YouTube, as long as we're not deplatformed. And you can listen to all of our podcasts on richdadradio.com because we archive it so you can listen to it again. When you listen to it again, repetition is how we learn best. Listen to it again, you'll pick up even more. But more importantly, if you have friends, family, and idiots, you want to listen to this, you know, especially if they believe in job security and a 401k, this is their program. Right? Any comments, Kim?
Yeah, well, I like this series because we're talking about taxes in the 4 different asset classes: business, real estate, paper assets, stocks, bonds, mutual funds, and commodities. We're going to talk about Bitcoin, gold, and silver. So a big subject that most people have today is called a 401k. It's called an RRSP in Canada. It's called a superannuation in Australia. It's called a pension plan in the UK. And it's
a 401k in Japan.
And a 401k in Japan. So let's dive into it. So 401ks, Tom and Andy and John, start the discussion.
Well, so I'll let Andy talk about this piece because he loves talking about it. But Andy's right. The big tax disadvantage is that you get a deduction when the money goes in. That's the big tax advantage. That's, as I've heard Andy call it, that's the bait, right? The problem is that you're not getting the tax advantages that you would have if you were outside a 401k. So outside a 401k, you pay capital gains tax rates in the US. Most countries have capital gains rates, which were about half of ordinary income tax rates. But if you invest in a 401k, when you pull that money out, it's taxed at ordinary income tax rates. So you take all the risk and pay double the tax.
So can I explain some of the 3 basic taxes? Number 1 is ordinary. That's people who work for money. 2 is passive, which is like capital gains. And portfolio. And the 3rd is passive, which is like, which I love, passive.
Right.
That's correct. Okay. There's 3 types of passives.
No, that's correct. And they're taxed, and those are the 3 different levels. So ordinary is taxed at the high rates, 40 or 60, depending if you're ERS. A portfolio is taxed at that 20%, which is where Bs are taxed. And then passive is typically taxed at 0, which is where insiders are taxed.
So Andy and John, you have a little bit of a different point of view. Andy, go ahead, and John, jump in anytime.
Well,
Let me hear this debate.
I mean, 401ks suck. If you want to, look, you can listen to John or you can go look at your balance and, go look at the balance that you have right now and you think you're going to retire on that. I'm very, very serious about this. John and I kid each other and we align 99% of the time. But the reality is just go look at your statement. Look, a pension I'm no fan of pensions either. But a pension if the company can survive and pay it, will last till you die. It's a bit of a golden goose. It's sick, it can't fly, and it lays tiny eggs, but it is a golden goose till you die. 401k is a golden egg that you'll consume. It's an hourglass. And from a tax standpoint, I agree 100% with Tom. They're going to say, well, you're going to be in a tax bracket that's lower when you're older. It's an assumption of being poor. And the only way you're going to get a tax that is lower is if you're in the bracket that is really, really low, which means you're not making any money. And that's the way I feel about it. It's a plan to be poor, not to be rich. And I think taxes will go up in the future, considering our fiscal situation. So I just think I like the zero tax of the Roth is what I like, is the zero tax of the Roth. Zero is better than a lot.
What do you think about the Roth IRA?
If your investment strategy is paper assets, a Roth is ideal, because while you don't get a deduction today, you never pay tax in the future. So a Roth is more for those who want to retire rich. Okay. Now, the good news in Canada as an RRSP, you have a lot more flexibility than we do in the US. Okay. So an RRSP, it's easier to get in and out. So that's a little easier one, the RRSP. You can time it better. In a super, that's actually a really nice plan, because you do actually end up in a lower tax bracket. So you do have to look at your specific country, and you have to look at, again, the Roth 401k is fantastic. I mean, if I were trading stocks, I would be trading in a Roth. That's what I would be doing.
Could I jump in here just a moment? If I'm listening and I hear, well, RRSP in Canada and super and all these, if you want to get a wide swath to understand this in your own country, wherever you live, is just take some time to study the difference between a defined plan and a contribution plan. And that's really a good way to look at it if you don't understand all those different names. Am I taking a contribution and putting in, or is my company just defining a benefit? And if you can understand that, you've taken a step towards
although Andy, really, both a super and an RSP are defined contribution. They're not the pension plan the company's putting in, and even the pension in the UK. A lot of that is employee. The employees can make decisions. Okay, so they actually put money in. So you do have to look at your own country, but I think the principles are the same all over the world. Okay, a pension plan is designed for you to retire poor. A 401k is designed to retire poor. An RSP is designed to retire poor, whereas we want to retire rich. And so we want to take a different avenue.
Right. So, and that's why I wrote this book here. It's called Who Stole My Pension? Because it's a whole nother wild card sitting out there, is because those of you with pensions, Wall Street might be putting their hands in it and taking out of there. I think the biggest question of all is this, because most people they start out, they go to their company and say, you want a 401k? I mean, I was asked that. I said, no. So John, what's your
argument for the 401k, John?
This is Rocky Balboa in the 10th round against Apollo Creed.
John, let me ask this real simple question. Let's say you start working for a company. They say, you want a 401k. Would you take it or not?
In a heartbeat.
You would?
Why?
Would you count on it? Would you count on it in 45 years?
Yeah, I would. And here's why. And by the way,
count on a 401k.
This is the debate here. Let's hear the debate. Let me hear the argument for. Come on, let's hear the argument for. Go ahead, John.
And here's why. So, and you mentioned your book, Who Stole My Pension? That's a perfect argument for a 401k. A pension sounds great. Yeah, work 35 years, work your tail off for us, and in the end, we're going to give you 80% of your salary. We'll hope to give you 80% of your salary for the rest of your life. Well, that all sounds great on paper, but look at what's going on today. And your book talks about it brilliantly with Ted Siddell. These pensions are way underfunded, and they're being contested in court, and they're winning against these employees. And these employees that have worked their entire life are seeing their pensions cut by 50%. I mean, just ask the iron workers in Philadelphia, I believe. I mean, they just saw their pensions cut. I think you had a guest on from UPS who's seen a 50% reduction in his pension. So this idea that pensions are great, is just a ruse. And by the way, that pension income you're getting on a monthly basis is taxed at ordinary income rates, the tax rates. Tom can tell you that. And I agree with everybody. Taxes are not going down. They're going up, given all this spending that's happened and will happen in the future. Taxes will have to go up. But I will tell you, if an employer is going to match my contribution for up to 4% or 6%, I'm definitely going to take that and contribute up to that. Then I would look at a Roth. Absolutely. I love Roths. The problem with Roths is that you're limited in how much you can contribute to a Roth. A Roth allows up to 7,000, Tom, or 8,000 now, whereas a 401k is up to 17,000. And here's the math. Here's why and by the way, 401ks are not the be all end all by any stretch. But for most people that are employees and will be employees for the rest of their life, they are great, because without a 401k today, you know what the retirement savings in America would be? Goose egg. There would be no retirement savings. The average balance in a 401k is 100,000, the median 70. The only reason it's not higher is because most people are not contributing to the 401k, and those that do contribute don't even invest that money. It sits in a money market, a cash account. But here's the math. You put $15,000 into a 401k or any retirement vehicle or any vehicle and earn 8% annually, you're looking at $1.8 million in 30 years. That's just
like a financial planner.
8% annually.
You sound like a financial planner. 8%.
I am a financial planner, and I'm just doing the math.
Andy,
I'd
go
rather
ahead.
have $1.8 million in my account than the hope that
You're assuming an 8% return.
Well, the average market, the market over time,
Don't give me this average bullshit.
done 10%. If you put
Go ahead,
money in the
Andy. Let me hear
S&P
your-
500 over the last 100 years, you'd have an average return of 10%. I'm using 8% to be conservative. Let's use 7%.
Let me hear the counter, Andy. Go ahead.
Well, if we want to talk about facts for a minute, look, if Robert holds up his chart, there's an ESBI, and pensions and 401ks are E-deals. So your choice is really, what quadrant do I want to operate from? So I'm no fan of the pensions, and I would never take a podium to debate for pensions, because they're robbed from Wall Street. They're underfunded. The companies often rated.
This pension here, these are defined benefits.
They suck. The debate is which sucks worse, and the level of suckery is very competitive between the two. Where I have a problem with the 1.8 million, dream world. If we want to stop smoking Colorado grade marijuana for a minute, just look at the facts. Look, just type in how America saves Vanguard. Just Google that, how America saves. Now there's about 4 trillion in the United States in defined contribution programs, and Vanguard's got 1.4 trillion of that money. So that's a pretty decent sampling, 1.4 trillion. And if you look at 2020, which is 2019, the highest the market was, right? Big high market, best 10-year run, better than that average we talked about, right? You'll find that people between 55 and 65 got about 70 grand. That's a long way from 1.8 million. And what they'll do is they'll blame you. They'll say, well, you didn't save enough. You didn't put in enough. You didn't make enough contribution. Well, I'll just say this. The 401k is fundamentally flawed in that it was never designed. It's like trying to take a tricycle and fly to the moon. It was never designed to get you to the moon. There was never a think tank of smart women and men that got together and said, what's a better way? Conable Barber in New York wanted to do some favors for his buddies at Xerox and Kodak and get them a tax benefit. 2 years later, Ted Bennett says, oh my gosh, we can shed the responsibility of this from the corporations. Mutual fund said, my gosh, we can have automatic payments coming in. It's called assets under management. We can have them on autopilot buying our products before they even get their freaking paycheck. And next thing you know, you got a destruction of any idea of investing and saving, and the biggest freaking thing wrong with it, and this is what pisses me off the very most, is they're telling people they can be millionaires without financial education. And that's baloney. You do. I don't know. You find me one person who was a peasant and got rich from more 401k and bring them on this program, because they're not there. They're
Okay,
not
I'll bring
there.
them. I'll bring plenty of people on this program that have made $1 million in their 401k.
Yeah, if they're already making
I'll show
500.
you all kinds of people that have made. Look,
They're great.
I get it. The
Wait,
401k was
wait.
never designed to be the sole retirement vehicle.
Bingo. Not even
It was
close.
never designed. But that's all we have. Pensions
Well,
are
yeah.
disappearing. So what's the answer?
Look, I'll
Social
concede.
Security doesn't work.
There's
You
no
say-
argument there. Look, I'll concede. If you want to be an E, if you want
Your
to be
only solution is universal basic income. That's what you're telling me. I'm waiting for a solution. I don't know the solution. You can say financial education all day long.
No. That's
People
look.
know they need to eat better
This is-
and
this
diet,
is
but they don't do it.
Wait. Hold on, you guys. Wait. This is not Peter Schiff versus
Robert Kiyosaki.
Okay. I mean, the point here is this: both John and Andy are in paper assets. Kim and I are not. And we kick ass without 401ks, without IRAs. We don't have any of that garbage.
Very true.
That's because we're on this side. And that's why this is a 4-part tax series. And Andy wrote the book 401 Chaos. Now, so you're in paper, John's in paper, Kim and I are not. Tom, any comments on what, because you're familiar with what Andy does and John does. How are they minimizing taxes?
Well, yeah. So what John's doing is postponing taxes to a later year. So, both John and Andy are right to a degree in that it does presume that you're going to, only way you get a real tax benefit on a 401k is if you retire poor. I've run those numbers 100 times. And now, what we haven't discussed is there's a very important word that we haven't brought up, and that's the word qualified. And a 401k, a pension plan, these are all RRSP, super, they're all called qualified plans, which what you can do is substitute qualified for government run or government ruling plans. Okay, so the government is deciding how you invest, how much you invest, when you invest, how much you can put in. John, you said it, how much you can put in. The government decides when you can take it out, how much money you can take out, when you have to take it out. The government decides everything about a qualified plan. What you guys do differently, Robert and Kim, is you don't invest in a qualified plan. You invest in a non-qualified plan. And non-qualified means I can do whatever I want. I can decide when I put the money in, how much money I put in, what I can invest in, what my tax consequences are. I can decide all of that, and I can do it way better than a qualified plan.
Yeah. So the point here, ladies and gentlemen, there's 4 asset classes. There's a business, there's real estate, there's paper. That's what John and Andy are experts in. They do very well in there, but they are qualified. They're pros at it. And the 4th are commodities: oil, gold, silver, Bitcoin. So Kim and I are in business, real estate, oil, gold, silver, Bitcoin. Can you explain what Kim and I do, Tom, that's different than most people?
Yeah, so really, if you look at it, first of all, you invest as insiders. Okay. And that's the most important thing, is you're in the I quadrant. And I wanted to add that you can be in the I quadrant as a paper asset investor. You can be a stock trader in the I quadrant. And by the way, the tax benefits are phenomenal. You get capital gains and get to deduct all your expenses. It's a tremendous place to be.
So let me ask Tom. So Andy does cash flow on the stock market. He trades options, things like that.
Trades options. So he gets the insider rules. If you're a buy and hold person, you don't get the insider rules. It's the traders like Andy, the professional traders that are particularly the option traders. They get, even though they're trading every day, they get more than half their money is long-term capital gain, which is at those lower rates, even though, you would think it would be ordinary because they're doing it on a regular basis. But it's the insider. The insiders have different rules in paper assets, and you have to know what you're doing. You have to have the education. You don't do this casually, okay? But in the I quadrant, you can be a paper asset trader in the I quadrant and bring your taxes way down, Okay. And you don't have to go to the 401k. John, you're absolutely right. If what you're doing is the buy and hold and your typical strategy, which most people do, diversify, et cetera, 401ks can make all the sense in the world if that's where you are. Okay. And I think that's what I hear you saying, Robert, is that, for most people, that's fine. And you get the match, et cetera. It's just that what we're talking about is, are there better ways? And what you guys do is way better, both from a tax standpoint and from a rate of return standpoint.
So the whole point here is that John and Andy, John, how long have you been trading?
Probably going on 3 years now. I'm using a very simple strategy that both Andy and I agree on. And by the way, I will fully, I can't say enough about Andy's options course. It's amazing. I use a very simple strategy. I look at it once a week, and it's generating nice cash flow in my retirement accounts, as my 90 soon to be 91-year-old dad is. So yeah, it can be, anyone can do it.
Let me say it again. There's 4 asset classes: businesses, real estate, paper, and commodities. And John and Andy are pros inside paper. Kim and I are not. Andy, final words.
No, I think it's a great discussion. And my number one, my life is about being an education advocate. People that want UBI, they're looking for a systemic solution. There isn't one. The ship's going to go down. It's going to sink. You can UBI all you want. That's just not, you just can't give people free money. My invitation to people would be, as an individual, what can you do? If the ship's sinking, you're going to wait for someone, or you're going to create your own lifeboat or try to find one. What are you going to do? And so I'm a huge advocate for financial education.
So let me talk a real simple question, Andy. My concern being a non-paper guy, because Kim and I have taken 2 companies public.
Yeah.
And we saw the inside of a paper market. I want nothing to do with it. But if the market crashes, can you still get rich?
Yes. In fact, I would say the opportunities, much like real estate, they're exciting when markets crash. We could do a whole show on it.
Yeah. John, will you make money when the markets crash? And it will
Absolutely.
crash.
There are always opportunities to make money when the market crashes. Absolutely.
Right.
Will a 401k person make money when the market crashes?
No, their portfolio will go down as the market goes down. Absolutely.
That's my concern. So final words, Tom, real quick on taxes, your favorite subject.
I love the discussion because it's all about education. And the more we only reduce our taxes when we get educated. We cannot, to take the simple way out and say, well, I'm just going to put money into a 401k. That's ignoring reality that there are so many other options that you can take advantage of if you get the financial education. So that's what I would say is you have to get, like Andy says, you have to get the financial education. You have to understand how the tax law works. But when you do, you find out that it's not your only option to do a 401k. That's not your only option. There are lots of other options.
Yeah. And I can say this for both John and Andy, John McGregor and Andy. Their courses are fantastic. John's more than willing to share his formula, how he makes cash flow on a regular basis, how he protects it from taxes and all this. But you have to invest your time and energy into the education. So I thank all of you guys.
Thank you guys.
Are fantastic.
Great discussion.
So I'm still never going to have a 401k. You can't convince me, John. But thank you. And we'll be right back for the final words. So thanks, you guys.
Thank you.
Bye-bye. Welcome back, Robert Kiyosaki, the Good News, Rich Dad Radio Show, the good news and bad news about money. And I want to thank, Andy Tanner, John McGregor, and Tom Wheelwright. Lively discussion on paper assets. I just can't get my mind around paper assets. I know it's stupid. Kim and I were offered Apple at $18, and I just turned it down on principle. Because I'd rather make money the old-fashioned way. I'm an entrepreneur.
Yeah, and we've taken the courses. We've done Andy's, stock trading options courses, and for me, I've taken several courses on options trading, and it just doesn't fit me. Yeah. It doesn't fit my personality. Yeah. That's all. It's not. It's because for some people, like Andy, he's phenomenal at it, and he makes a ton of money at it. And for some people, it works really well. But you got to find that asset class that fits your style.
I took 3 years of options trading in Cary, North Carolina, and it was a complete waste of money. Not because the course was bad. The course was fantastic. I'm just stupid when it comes to that stuff.
Well,
and my brain doesn't think that way.
I do remember at one course, and the instructor said, okay, so watch such and such, and when it gets to this point, that's the time. And like, I am glued to the screen all day long, waiting for that one little thing to happen. And I'm like, I can't do this. I have no life.
Well, that's why John McGregor's plan is probably the better plan. He's happy to share it. They're great guys. Any comments there?
No, that was a great show. I never expected taxes and paper assets to be so lively. I will say, Kim, I agree with you. Andy, this was probably 3 years ago. We got together as a team here at Rich Dad. Andy walked us through one of his options courses. I got in 3 minutes and I was like, this is a language I don't understand. But half the guys were totally into it. So it's
Correct.
really, like you said, it's really what inspires you or interests you.
Yeah. You know what I love too about this discussion, the debate between Andy and John, was that it's a perfect example of what we talk about, 3 sides of the coin. So John had a point of view, Andy had a point of view, and it's up to you to figure out what works for you and find out, the real information. Just don't take somebody's word for it. Really do your own homework.
And a 401k is great, especially if you don't want to study. If you don't want to study, you don't want to do real estate, you don't want to do commodities, you don't want to do anything, 401k is perfect.
But I would get 401 chaos because that did open my eyes as to all the fees that are taken out and how the system works. So that alone, if you have a 401k, you should at least get that book.
Yeah, and just don't believe what they say. It's the only way a 401k works from a tax perspective is, let's say you're making $100,000 a year when you're working. It only works if your income goes down to $20,000 a year, then you get a tax break. So there's more tax efficient vehicles than a 401k, but you have to do your research. We're not saying don't do it, but that's up to you.
And isn't it silly when a financial advisor says, well, now that you're retired, you're going to be making a lot less money, and people go, oh, okay. I'm like, why is that okay? Why can you not be more creative and make more money once you leave your job?
It's a good thing we didn't follow that advice, man.
I like that was something Tom kept saying. Oh, they're designed for you to retire poor.
Yes.
That's so simple.
That's the problem with the 401k.
Yeah. Yes. And people just blindly accept that.
And the other thing, when John says it goes up on average 8%, I nearly wanted to vomit all over this mic, because markets go up and markets come down, a 401k, I'm going, don't buy it. But the thing I love about John, he is for real. I mean, he goes to listen to every time a financial planning show comes to his part of the world, he's in the audience and he pretends to be stupid. Not hard to do for John, no. But he asks them questions to kind of set them up. I think the funniest one was with this one guy's up there, he's talking and all this, and he says, this is great, he sounds good and all this. Then he finds out the guy's not even a financial planner. He's a Hollywood actor. And John sat there and goes, oh my God, he sells pizza, on television. But so look, let the buyer beware. So this is a great program. I want to thank the 3 of them and all this. And it's an exciting time to be in the financial education business. Final words there, Sarah?
No, just great show. Looking forward to our next couple shows. We have one coming up with Tom and Ken, and then the commodities show. So look out for those.
Right. Taxes with real estate, and then taxes with gold, silver, Bitcoin. We did one with Tom and Garrett, taxes, and asset protection using entities like S corporations, C corporations, and LLCs. You got to know that. If you don't want to pay taxes, don't watch it. But the biggest one is coming up with Kenny and Tom, because Kenny, Tom, Kim, and I, the reason we pay 0 taxes is the same Trump doesn't pay taxes. We're real estate guys. Thank you for listening to the Rich Dad Radio Show.
Thank you.